Today's topic, 5 must-know tax moves for high-income households before year end. Whew, that was a long one. I actually had to look down, that title was so long. So goal today is to walk through what I would label as really 5 time-tested strategies as you start to prepare for year-end tax planning. I know you're thinking, Chad, it's only September. This is the magic time, baby. This is the time that you have without stressing to prepare for your year-end tax planning. So that's why we hit it a few months early. So we are recording this one at the end of 2025, so headed into 2026. However, we do believe, at least historically, a lot of these have been time tested. So we got some heavy hitters, ones that are very time tested, maybe just maxing out a 401k plan. But we also have some unique ones in terms of, how about Roth conversions? How about the extra tax surcharges you may not know exist and how you can maybe lower them or avoid them? Yeah, that's right. All that coming up next. All right, we put a little plug now in at the start. Keep it short and sweet. If you have not subscribed, now would be a great time to do that. If you don't feel like doing that today, at least give us a thumbs up. Share this message with all the others that need to hear it. If you click on the bell icon, you also get a notification every time we release a new video, which we do weekly. That's it. That's the sales pitch for today. All right. First and foremost, I am still amazed by how many, I don't want to say miss this, but misjudge the power of this one. But good old max out your tax advantage accounts. I know it's not sexy, it's not rewriting the tax laws, but this is one of the biggest tax savers for so many of you, especially for those of you who are high income, looking at all my favorite physicians out there. Also my dentists, my vets, my business owners, we got you. But still, physicians are our main group here. Just the little things. Maxing out your 401k or 403b. Do you have access to a 457b plan? Don't forget, there is a difference between government and non-government. Did you max out the HSA? Did you get your backdoor Roth IRA completed? Did you put some money in the 529 plan for the kids yet? How about you with the 1099 income? Did you get some money into that solo K? Mega backdoor Roth. That's another good one. If you have access to it, very popular topic. Everybody loves it, but not everyone has access to it. Check out some of our past videos on that one. But max out the tax advantage accounts. If you're sitting there as a high income professional, maybe it's high 20s, maybe it's low 30s, maybe it's mid 30s, maybe you're sneaking up into the high 30s. But regardless, that is the savings on a dollar, right? You put an extra dollar into the retirement plan, 37 cents saved. Let's just say you're in a 37% tax bracket. So low hanging fruit. And now I use the word save, but don't forget, this is technically tax deferment. But if you do it right, we'll cover Roth conversions at the end. That would be one way to hopefully lock in some of those as an actual tax savings once you get it out of the pre-tax stuff. So again, not super sexy, but darn, it is a vital piece to your personal finance foundation. Get those tax advantaged accounts maxed out. Again, I do include 529 plans in there. Remember, 529 plans do not do anything for you on your federal tax benefits. It is more of a state play, and not even every state offers it, but you do get tax deferred growth, which is why we're still a big fan of 529 plans. All right, number 2 on the list. I shifted my list around a little bit. Tax loss harvesting. Again, another favorite buzzword out there. What the heck does it mean? Well, it's your opportunity to maybe have some funds that have losses for the year that are maybe easily replaceable with something similar, but not too similar. Looking at you, wash sales, and you can lock in those gains, which is important to offset not only future gains, but remember, you also get a little bit of tax arbitrage up to $3,000 per year where you can offset current income as well. And if you're sitting there as a high income household, that's why we call it tax arbitrage, because you're getting a pretty solid deduction on that $3,000. Tax loss harvesting is it's literally ingrained in what we do. To me, I still consider it table stakes. I believe that, it's just something that we do. You don't want to get too carried away with it, right? You got to follow some systems here. You don't just want to go, hey, sell everything, whatever. We'll realize the losses. You want to have some systems in place because at the end of the day, you're still just deferring gains in the long run. But tax loss harvesting is a great strategy. Again, watch out for that wash sale. Another topic that I do bring up, usually closer to an election year, Clearly, at the time of this recording, we likely know that we're probably in a very similar tax spot, at least for the next few years. But tax gain harvesting is another strategy. If we were sitting at a year where we do believe that capital gains rates are going to go up the following year, it's not a bad idea sometimes to actually take some gains in a current year to lock in lower tax rates. Again, that's not the case as we sit here right now, end of 25 into 2026, but something to keep in mind. Tax loss harvesting is something you should certainly keep an eye on. This is also something you don't want to wait till December 25th for. Ideally, hopefully you're enjoying a holiday at that point. But later in the year, you start to get a little bit close to it. But starting to go through it, at least maybe looking at the strategy this time of year, maybe pulling the trigger a little bit closer to October, November. But regardless, you want to have a system in place here. But tax loss harvesting is a great tax move for our high income households, really all households. Number 3 on the list, we got charity. And we got three ways to take advantage of charitable giving. So when we get into tax planning with our clients, I probably said this in a few videos now. If you're taking the standard deduction and still giving money to the Red Cross every year, remember that check to the Red Cross, even though you think that you got a tax deduction for charitable giving, you didn't. You took the standard deduction. Now, I know you didn't give money to the Red Cross for a tax deduction. I know that's not you, but it is a side benefit, right? So some ways to get over this, because the standard deduction has been high. We know that it's going to continue to be high for the next few more years. You want to be strategic with your charitable giving. And there's 3 ways to do that. The first one is a very simple one. We just call it bunching contributions. So you can do this 2 ways. You can do it in a given year, right? You could say, hey, instead of giving the Red Cross, I'm going to use $10,000 per year. $10,000 per year. I'm just going to give them $30,000 this given year, and then I'm not going to do it for the next 3 years. So I'm going to get that full $30,000 in this year, but I'm not going to do the next few years. By bunching them together, that larger $30,000 compared to the $10,000 is going to help you get over the standard deduction and allow you to then itemize and take advantage of that. One thing I always note, if there is a larger gap in your itemized versus standard, you will lose some of that, right? Let's just say you were on track for $20,000 of itemized, $20,000 of itemized, and the standard was 30, and now this extra $30,000 puts you over, right? You went from 20, now 50. You still used up about $10,000 that didn't really get a benefit, right? Because you would have had the 30 regardless in the standard. So just the closer you are to that 30,000 before the standard deduction, before the bunching of the contributions, the better. You'll get more bang for your buck there. Another way to do the same idea with bunching, but just spread it out, if you're a person that says, oh my goodness, if the church doesn't see me drop this check off every single year, we're going to get kicked out of the church. You could also use something called a DAF, a donor advised fund, where you can put $30,000, again, this is just our hypothetical number, into the DAF, the donor advised fund, and then divvy it up each year by giving $10,000 each single year. You accomplish the same goal, because in that first year, you will get the $30,000 deduction from the donor advised fund on your tax return. And then when you give out the next sets of 10,000, you won't get a tax deduction for that, right? You got it all up front. But that gives you a way to make a lump sum and then spread it out. And ideally, you invest it in there, you get some growth in there. Clearly, we just hit a 3-year window. 3 years, the market can do a lot of crazy things, but keep that in mind. And then for those of you over 70 and a half, which is a very large growing demographic on YouTube. So if you are over 70 and a half, welcome. There's a lot of you out here now. QCDs, qualified charitable distributions. When you have to take those cranky little RMDs, now RMDs are now starting later than 70 and a half. We kind of joke that this is definitely like a mishap in the current tax code, because QCDs are still at 70 and a half. But when those RMDs start, when Uncle Sam forces you to pull the money out, a really neat strategy is these QCDs. You can actually start to direct some of your RMD towards your charitable giving. So instead of you taking a $50,000 RMD, you might say, hey, Chad, send me $25,000 of that, but then send the other $25,000 to the Red Cross. That'll be our charitable giving this year. That's a great idea. One, because remember, RMDs are fully taxable. So you avoid taxes on that. But also, where were you going to write the check from initially? Probably from your bank account. What's the downside of that? Well, your bank account is basis even, right? You don't have a gain or a loss in there. So it's a valuable asset. You don't really want to give that up. Ideally, when you do the donor advised fund, you also have a chance to take low basis positions, so positions with very large gains, and then donate them to the donor advised fund. And that would be another way to take advantage of the system. Now, with the QCD, you're just doing this because it's coming out of your IRA, right? It's in your IRA. It's a forced mechanism, but you got to pull the money out. But I did want to note that quickly there on the donor advised fund on some wins you can get in there. But with that QCD, remember, you will have the option to push some of those RMDs. Now, technically, you could do a QCD before RMD start. Again, going back to that age loophole I noted there, 70 and a half is when those start. And you could start saying, hey, instead of writing a check out of my checkbook, I can then send the money directly out of my out of my IRA. When RMD start, I think it's a little bit easier because the money's getting pulled out regardless. So keep an eye on that. 3 really unique ways to take advantage of the charitable giving. Bunching your contributions, just straight up tax return year. Doing the same thing, but with a DAF, a donor advised fund. Or if you're over 70 and a half and you're getting into the area where you can make those QCDs, or when RMDs start, you can also direct some of that QCD. All right, last 2, surcharges. There's 2 surcharges that we always tell our high income households to keep an eye on. There is 3.8% for NIIT, net investment income tax. When does this kick in? Joint taxes over $250,000, single over $200,000. There's also another 0.9% for Medicare. So these are 2 surcharges that can sneak up on higher income households. So keep an eye on those. Some unique ways around this. One that we love, continue to take advantage of municipal bonds. Keep an eye on your year-end dividends, your year-end capital gains. Those also function in here. This also can kind of lead us down a path for A&T, alternative minimum tax. But that is one that I feel like a lot of high-income households, they don't even know it's out there. So we try to bring that to the attention as much as we can. When's a good place to do that? Well, YouTube, because it spreads out a lot more. So watch those surcharges. The one that I shifted around a little bit was my number. Well, originally was number 2, but I moved it to number 5. And the reason why I did that is because Roth conversions are one of our favorite tax tips, one of our favorite tax strategies, but they only really make the most sense for years that your income is lower. Now, if you're watching this in your mid-30s or mid-40s and you're like, well, I'm taking a 2-year sabbatical. Well, guess what? This Roth conversion strategy could fit much sooner. But for most of you, this doesn't get excited until closer to retirement, or maybe like you're starting to kind of dwindle it down, maybe part-time income, or you're completely retired. But the years between retirement or a very large decrease in income and your RMDs, which if you're younger watching this, most RMDs will fall to 75. Really, that number can range now a little bit just based on birth year. But for most of the younger generation watching this, just call it 75. So maybe you retire at 65, RMD start at 75. You have this 10-year golden window. Do not allow those lower tax bracket years to go by. Because what will happen is, because you were a diligent, high income saver, you took advantage of the 401k, maybe the 403b, you had the 457b plan, maybe you had a cash balance plan going as well, you had some 1099 income, you did a solo K, you did what you're supposed to do, you followed the playbook. You deferred as much as you could at your highest tax brackets. Well, now, like I said, remember that first one, now's your chance to maybe lock some of this in by now getting out of the pre-tax stuff and into a Roth. So if you're in a 10, 15, 20% tax bracket in retirement, don't let those years slip by before RMD start. Because once you hit RMD age, if you have large 401k, ideally probably in an IRA by this point, when Uncle Sam starts forcing you to pull out, call it 4% or so, you can easily jump back into extremely high tax brackets, sometimes even higher than what you had while you were earning your peak earning years as a physician or dentist, lawyer, vet, whatever. So keep an eye on that. Roth conversions are a huge value add. I often say, when we build these out and we have a longer window in there with someone who had a lot of pre-tax savings, 6 figures of tax savings potentially, sometimes 7 figures of tax savings potentially, by just taking advantage of those lower tax brackets. So I always describe it as, we're going to force your tax bill higher in that window to then lower your tax bill for the rest of your life. Because by moving more pre-tax to Roth, what does that do? It lowers your RMDs. So instead of being forced into higher tax brackets, we're now in a much better control metric there. So those are the 5 that we got. Max out your tax advantage accounts. Tax loss harvesting. Sometimes keep an eye on tax gain harvesting. Charitable giving. Watch the tax surcharges. And number 5, Roth conversions. If you have questions, comments, anything you'd like to hear more on, drop us a comment below. You know I love to get back to every single comment that we see, as long as they're not spammy. We love to hear from you. We literally love building content around you. You can also use the link we have in the show notes to send us a more personal note, and we can also work to cover that on one of our next episodes. So, as always, thank you for hanging out with me the last 15 minutes or so, and I will catch you on the next video.